And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon. I can't believe it's Friday again.
Yeah, I know. It's a little bit frightening, isn't it?
It is a little bit frightening. We had a pizza party in the office today to watch all four big screens showing the Socceroos game at the World Cup. A 0-0 draw is enough to make sure the Socceroos progress, which is great. I tell you what, it was nail-biter.
Yeah, look, it was definitely up and down. It was a little bit more exciting than I sort of expected. I thought they'd just park the bus and just not lose, and they had a crack. And it was.
Anyway, it's great to see that the Socceroos are through, and I've unfortunately eaten more pizza than I should.
Look, that's okay, and they get a few more bucks so they don't fall into bankruptcy. So they can have another campaign, and the further they go, the more money they get, and that's the thing.
Excellent stuff. Now, I can't believe, the other thing I can't believe is that next Wednesday is the 1st of July. It is the beginning of a brand new financial year. And there's a lot of things happening from the 1st of July.
Correct.
Today we're going to focus on one particular aspect, and that is superannuation changes. And apparently there's quite a few.
Yeah, there are. Look, it's one of those things that we've been talking about, and all of a sudden we're here, and I guess we're just going to sort of run through some of the caps, what they are, what they'll go to, and just give people a little bit of an idea so they can start planning for next year, because some of the changes and balances will affect what they can do now and obviously into the future. And we also saw in the week, as you've sort of dropped here in this article, that
well, I found a report about, there's lots of reports about this story, but I found a report about the change that was made in the Parliament this week about self-managed super funds, and apparently the government has been under pressure to make changes, including the idea that they should ban self-managed superannuation funds from borrowing in order to purchase residential properties. Now, I'm scratching my head. I'm okay, why?
Well, good question. I think maybe Xi Jinping's been on the phone and said, we need to spread the wealth, and how dare people work hard and accumulate assets and buy things that they understand and are comfortable with to fund themselves in retirement and borrow money to do so. It's a little bit baffling. I'm not sure what it's going to achieve, because people that buy self-managed super fund assets can't use them. You can't live in them because you'll breach the in-house asset rules. So what you're actually securing is a rental market and a supply of rental properties as one way to look at the benefit of people being able to use their super to buy assets that they're comfortable with. And a lot of the time, it's not that people are busting to do this, it's that they're buying an asset class that they are familiar with. And in some instances, using accumulated superannuation to get into a house that they can own because they can't afford to do it in their own name. So this is actually, again, another piece of legislation that has blown up in their face, because if you had a couple and had combined your super and bought a house, it would have been a faster way to be able to acquire a property, because you may not be able to save for a deposit in your own name. But if you've got someone in their 30s, potentially early 40s, who've been receiving super since they started working, and you combine two balances, you'd have the means to be able to buy something so that you are in a property market. Now they've gone and taken away negative gearing. They've taken away people's ability to borrow and fund a property and hid behind, well, this is helping younger people get houses. No, it's not. It's actually helping older people who already have a ton of houses get more houses, because they can negative gear against rent. You can't negative gear against wages. So it's actually achieved the exact opposite of what they've been spruiking. And now you've taken away someone's ability to use a large asset base to buy a property that they could maybe not live in, but at least own and benefit from the upside of capital growth. Now they've taken that away from people as well. So he should actually just come out and say he hates young people buying houses. He hates young people having a crack. And how dare anybody try and acquire anything over their working life? Because that's exactly what this has effectively achieved.
Well, of course, the main bill for the tax reform package passed through the Senate last night. That's done and dusted, but with some changes that were debated. One of the things, the deal with the Greens included this measure to ban self-managed super funds from borrowing to purchase residential properties. I believe those funds could still buy a property. They just can't borrow to do it.
Yeah, correct. That's my understanding. You can still buy something outright where you have the capital.
Yeah.
But it's also, again, this isn't going to affect housing affordability. If you want to affect housing affordability, they need to sit down and remove all of the gargantuan amounts of red tape and incompetence from local councils and other areas that make it so hard to build something or get something done that people either give up and then go back into the buying pool from a diminished supply avenue.
Yeah,
there are much bigger regulatory problems than the legislation around doing it. Build houses faster, take away the red tape, and remove some rules that I speak to any building client I've got. They're ripping their hair out because the rules are made for the minority. In that you have to have this and you have to have that and you have to have this. It's like an element of wokeness has leaked into the building world. And now everything's getting built for, your 1 in your million scenario, which then comes at added costs, added paperwork, added compliance, added checking. Now, there's an element of protection for the community because we've all seen, stories of shonky builders, and there were some great things on YouTube with some in Canberra earlier this year.
Yeah.
But it's out of control.
The issue, of course, is supply and demand. If you want to address affordability, what you need to do is either increase supply or reduce demand. Now, you can't reduce demand really by telling people, "Oh no, you're not allowed to buy houses." No. So the only option is to increase the supply. So what is it that's preventing supply? Well, you've identified one of the issues, and that is the extensive red tape and the high fees that developers need to pay, and the hurdles that they need to jump over. There are other factors as well, but at the end of the day, it's going to take a significant investment from government in social and public housing to take pressure off the market so that the people who are less well off are catered for and they are actually removed from the private market, which then reduces the demand.
Totally. Look, there's a myriad of things that can be done here, and I think they're driving down a lane. I'm not sure. It's like they're driving in the dark looking for street signs. They're not sure where they're going with this, and they keep compounding silly decision after silly decision without actually thinking about what the outcome of it is. And I bet if you looked, and I don't know the numbers, but if you looked at the proportion of houses sold in Australia that are owned in a self-managed super fund, it'd be like trying to empty the ocean with a teaspoon.
There's not that many.
No. So it's, again.
It was a strange decision amid a raft of very strange decisions. And we've sort of wandered a little bit away from today's topic. But obviously the changes to capital gains tax, negative gearing and the other associated measures that have been introduced by the recent federal budget, the government is telling us that, it's to make housing more affordable and to make the tax system more fair for younger people.
No, it's not.
It's how does changing the arrangements for share investments or for trusts, how does that actually make things more affordable or more fair for young people? It has nothing to do with them.
And again, it doesn't. And I think all they've done is they've had this inappropriate lens of social conscience, if that's the right way to put it, where they've gone and made rules because of these horrible, horrible, hard-working rich people. Oh, my Lord, how dare they spend 80 hours a week away from their families.
I've told you before, Luke, of course you have to tax the rich. They're the people with the money.
They're also the ones that get nothing for their spend. So I think, like anything, there has to be an element of normalisation. But, a lot of what's going on at the moment is not going to improve. And we'll see. Time will tell.
Time will tell. We've got roughly 2 years or slightly less now, until a federal election. The proof of the pudding, as they say, is in the eating. So we will see the actual results before we go to an election. Is housing more affordable or is it not? Has the cost of living improved or has it not?
And the funny thing is that even when they'll sit before a Senate, they'll just take it on notice and nothing will change anyway.
And
it'll actually be quite funny when they get torn apart because they won't have any numbers. They'll try and manipulate some figures, and we'll be no better off as people in broader communities from being able to afford anything, because nothing's going to move to help the younger people. And my kids will be just like the 20-year-olds now, going, how come this is so bad? We'll just kick the problem down the road. It's not going to change anything.
Are we actually going to talk about today's topic at all? Because we're running out of time, So there's a few changes coming in on the 1st of July next week. What are the most important ones?
So from 1 July, you can make a concessional contribution of $32,500. You want to talk about meaningful changes? Wow, this will really rock the boat. It's going from $30,000 to $32,500. That is just phenomenal. Mm-hmm. Non-concessional contributions are going from $120,000 to $130,000, which means that if you do a 3-year contribution, you can get $390,000 in, not $360,000. So you can get a little bit more in and not claim a deduction. Transfer balance cap for those people starting a pension. The most you can have in a pension account is $2.1 million, not $2 million. So that gives you a little bit more room to have a little bit more in your pension structure where you'll benefit from tax-free earnings, no capital gains tax, etc., etc. Total super balance is increasing from $2 million to $2.1 million. So that's your eligibility to get money into superannuation, and there's a sliding scale associated with that. So don't just look at this and go, "Ooh, I'm under 2 million, I'm under 2.1, I can throw in 390." It doesn't work like that. There's a sliding scale back from 2.1. Another wonderful piece of legislation for every self-employed person out there: super is going to be paid on a fortnightly basis from 1 July, which will probably blow up most people's computer systems, or Xero, or somebody's payroll area is going to be working extra hard to transition that in.
I'm pretty sure MYOB and Xero can handle it.
Yeah, true, but someone's still got to do it.
Mm-hmm.
Div 296, that's coming in from 26 and 27, so that's that additional 15% on balances over 3 million and 10% on balances over 10 million. And there's a calculation methodology that needs to be applied there, so don't panic if that applies to you. Just go and see your trusted advisor; they'll be able to work it out for you. Government co-contribution thresholds are going up a little bit at the moment. The low end is 45,400. Top end is 60,400. They're increasing slightly to 49,000 and 64,000. So there's a little bit of room in there. And for the small business owners, and the CGT cap is going from 1.895 million under the lifetime cap to 1.935. So it's just a marginal increase on what we already know are the eligibility criteria and thresholds for adding money to super, and for taking into account contributions and pension drawings. So is there anything meaningful there? No. Could it be advantageous for you to understand and use in the future? For sure. And we're just raising your ability to go and look at that now and say, okay, if I'm salary sacrificing from 1 July, I can go to my payroll and say, hey, can you put in a little bit more? Great. If you haven't used your catch-up space, have I got the ability to add some looking back 5 years? Great. If you're coming into 30 June now and your balance is really close to $500,000 and you're thinking about using your catch-up space, if you are eligible, try and get your balance under $500,000 by making a withdrawal, because that could allow you the ability to use the catch-up concessional legislation next year if you're planning on selling a property. So be mindful that you should have all your money in by now. If it's not, good luck. You're really sort of skating on some thin ice. But it's definitely something that people should be aware of.
Luke Smith from Envision Financial is with me in the studio today. We'll be back with more in a moment. Luke Smith from Envision Financial is in the studio with me, and today we're talking about some of the changes that are taking place from the 1st of July, which is next Wednesday, and specifically in relation to our superannuation. So what do we need to remember?
So the first one is use the legislation to your advantage. Check your thresholds, understand what's available to you, and assuming that something isn't of benefit to you could be a very, very expensive assumption, because there may be an application that you haven't thought of, or a test case where you could say, well, if I did that, I could do this, and then I'd benefit from that, and that's worth. I had one this afternoon. Oh, that won't be worth anything. $6,500. Oh, well, okay, yeah, I'll do it. But thought it wasn't applicable. It was. So don't assume, check your limits. Make sure you take steps before 30 June to get balances out. So again, really, really tight. But if you've got a self-managed super fund and you're tinkering on or just over 500,000 and you're thinking about making a contribution, get it down. If you've got a balance that's within the total super balance limit and you're thinking about putting big licks of money in next year because you might intend to sell a property, get money out so that you have room, because your eligibility for next year is measured at 30 June balances this year. So you need to be proactive. Use the bring forward rules to make deductible contributions. Speak with employers if you've got salary sacrifice arrangements or you're making catch-up payments through your workplace. Speak to them about changing it to maximise the little bit of extra space you'll have from 1 July. Make sure you've got all your paperwork in. If you've made non-concessional contributions, check they've landed. If you've made deductible contributions and used personal money, don't forget the notice of intent. Now, the notice of intent does not have to be at the fund before 30 June. A lot of people coming in going, oh, I've got to do the contribution in the fund and the paperwork. No, get your money in, get it cleared. You can send your notice in July. That's fine. I generally say do it around the same time so you don't forget. Make sure that you don't exceed limits, okay? You get a lovely letter from the ATO and they're really friendly. They'd love to take some more of your money if you get it wrong. So again, I think I'll just chuck in that much. No. Don't think, don't chuck in. Understand and place. And then if you're not sure, speak to your accountant, speak to your advisor, and that way then you can proactively move into the new financial year with some direction.
Yes, and of course the big day is Wednesday. So for a lot of things, you may have left some, strategies too late for this year, but there's always next year, of course.
Correct.
Learn from this year's mistakes.
And if you get this year wrong, guess what? You've already said I'll sort it up next year, so that's fine.
Exactly right. All right, so Luke, where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify, and the big one, we've got everything on Envision Financial Canberra's YouTube page where we've got a back catalogue of all of our shows. And we've got Smart Money Strategy, your ultimate guide to financial planning, where there's chapters on all of these contribution strategies to lower your tax.
And if you buy the book before the 30th of June, for the purposes of making investments, you could potentially claim it as a tax deduction, but check with your accountant first.
Well wrapped up there. Check with your accountant first.
I just thought I'd throw that one in there.
Exactly right.
But that's the thing about checking with your accountant. Often, you can be claiming for deductions that you haven't thought of. So that's always
also
a good
depends
idea.
if your accountant likes you, because they might go yes or no. So.
Yeah, well, exactly right. Luke, thanks very much for dropping by.
See you next week.
Luke Smith from Envision Financial will be back with us again next Friday afternoon at the same time.